Hey there traders, Ed here from Option Informants. If you missed our live webinar on EarningsBot, here's the recap video of our live session earlier today. Yeah, so again, what's today? January 28th. Yeah, so tomorrow's end of month for the stock market. So today we are reviewing our EarningsBot. So this is a fantastic algorithmic script that Joe and the team here wrote, and it's really takes advantage of earning plays and upcoming earnings. So we're going to jump into it, talk a little bit what it does, how to set up the trades, and go from there. Let's see here. All right, so obviously before we get started, a little bit of risk disclosure. We're not financial advisors, we're not a broker. Anything from Option Informants is for educational purposes only. Anything in this video presentation may not be copied, recorded, or redistributed without written approval from us. And again, investment, there are risks. Understand your security, understand your risk, understand that there are losses, and obviously invest responsibly and appropriate for your account size. Now, with that out of the way, let's go ahead and jump into this. So what we're talking about today is one of our two algos that we've developed here, our EarningsBot. And without giving out too many of our secrets, right? We really are just utilizing market trends and how individual stocks perform. And there's this phenomenon as earnings get closer for a stock, right? So for example, Amazon will be reporting sometime next week. You'll notice that the stock typically has momentum towards the upsides and starts increasing the closer we get to that earnings report. So we've performed multiple back analysis and different scenarios and try to find the best possible place to improve our chances of capitalizing on that. Now, the advantage of this is, obviously, if we know which place to make, we're able to reduce our risk, right? We're not going out there just buying every possible stock that has an earnings coming up. And we've also simplified this just to two basic types of option strategies. One's a very basic call option, and the second one is a diagonal. And we're going to dive into those into more detail in a bit. Now, what's also great about the EarningsBot play is they typically last less than a week, right? So you jump into these trades, and usually within 2-3 days, I'm usually either closing out either for a win or for a loss. But it's lasting less than a week, and the advantage of that is you're not caught in turbulence or volatility like we're seeing in the market. If the market goes down for a couple of days and you're fully invested, you're going to feel the pain because you weren't able to exit appropriately. The advantage also of trading in less than a week is you need less capital, right? You're able to buy these options with less money. They don't take up too much of your portfolio, and again, reduces your risk of any downside. And finally, it simplifies the psychology, right? I've noticed this with myself and many other traders. When you jump into stocks, especially if you're new to them, there's a lot of emotion, a lot of excitement that's built into them. And when you understand, where your profit is or where your stop loss is, it helps mitigate that a little bit more. And so again, once we jump into the example, you'll see in a bit how that's helpful. So real quick, do want to just jump into the performance now. We activated this season 2 version of EarningsBot on the 21st of January. And let's see here, see if this cooperates. And so since then, we've had 6 trading sessions, right? And so let me see and so we usually track all our performance on different plays. And as you can see here, anything that says EarningsBot is an EarningsBot call. And so far in the 6th trading session, the bot itself, it's up 154. So obviously you can see there has been some losses, there has been some wins. And again, if you've been keeping up with the market, right? I mean, the last 6 trading days, right? I mean, especially yesterday was quite a doozy, right? So to be up in those past 6 days, and we're still, in the beginning of earnings season, it's definitely a good start.
I think it's also, don't mean to interrupt, but I think it's also
Mhm.
important to note that when you are taking these trades, you should make sure that, and we're going to cover a little bit of position sizing a bit later, but you should make sure that your position sizings are always equal and always only a fraction or a percentage of your actual trading account. And this way, over the course of time, you can produce exponential gains. And here's our risk management slide. But in order to be a disciplined trader, you definitely want to follow this 2% of your total account size. This is going to help. Again, just over the course of time, there's always going to be losses. I don't care what system you use. I don't care what bot you're using. So it is important to take that into consideration. So in the example below, a $10,000 trading account should only be traded, and any account really should only be traded at 2% of your account. So you should only be taking $200 position sizings on whatever trade you do.
And I mean, that's right in the head. And we're also going to talk about probability and profitability based on that as well, right? But yeah, to Joe's point, typically 2% is a good a safety target. Once you become a little bit more of an advanced, trader, you'll have better understandings of how much to actually position size, when to increase, when to decrease. But again, the fantastic part about earnings bot, right? It's as long as you enter with a appropriate amount size and you follow the strategy, you should be setting up for profitability.
Yeah, following the strategy is key too, because it does define exits and entries for you. So before you even get into a trade, which comes back to the trading psychology aspect of this, before you even enter a trade, you want to already have an exit in mind, and you want to be rigid on that exit. You don't want to fluctuate on it, and EarningsBot does this for you. So
yeah, it's I mean, I'm getting excited. So let's get through this. We can jump on the platform, see the couple different trades. But again, we're only using 2 strategies. So the earning bot only provides you 2 different strategies. One is just a long call option, right? So, and we'll get into definitions in a second. And then the second one is earnings diagonal. Now, you can see there's different option level requirements, right? So depending on which level you have in your brokerage account, you may or may not be able to pull these trades. Now it is pretty easy to get option level 3 nowadays. So, and we'll talk about the risk of each one in a moment.
And if you need help finding those, you can always just reach out to one of us and we can help you try to achieve those.
So real quick, just to go through the basics, right? So a long call option is an option contract that gives the owner the right, but not the obligation, to buy a specific amount of an underlying security at a specific price within a specific time. Now, you can read this definition over and over again, and it usually doesn't stick until you put some meat in the game and you start trading. But the biggest aspect to take away from this is that if you buy a contract, right, you have the power of whether you exercise and buy the stock, whether you sell the contract, or whether you do nothing with it and just let it expire worthless, right? It loses all its value. And again, the biggest thing about this is that there's no assignment risk, right? We all hear those rumors of, and the stories, right? The horror stories of people getting assigned contracts and stocks, and then they're short, $30, $50, $100,000. Now, a long call option, that's not possible, right? And so in our earnings bot, the way it's called out, at least in our Discord, it does look a little different on Twitter, but on our earnings bot, this is pretty much what you don't have to memorize it because it's in the Discord, but this is what you'll see. You're looking for a contract that has around 7 days to expiration. You're looking for a 40 delta, and you're looking to target 40% profit, or you're going to stop out at 40% loss. Right. So to Joe's point, when we talk about, the psychology of trading and understanding the strategy, you got to keep in mind, as the stock starts moving up or down, you're going to want to exit once you're near your 40%. You don't want to, get emotionally tied to a stock and see that it's going up. And then you don't want 40%, you're shooting for 100 or 200. And then next thing you know, the position turns on you and you end up losing, the profits you had on the table. Now, the second one real quick, and again, I'll show both of these in the platform in a bit. It's a diagonal spread. So now this one, it's an option strategy that involves buying or selling a call at one strike price at one expiration, and then selling or buying a call at a different strike price. Now we are doing long diagonals. So what you're doing is you're selling the front and you're buying the back. And we exit this position when the short reaches expiration. And again, this is going to be confusing. Once we jump in the platform, it'll make a lot more sense. And again, the way it looks in our Discord, right? You can see here, this is Pinterest. And here's your buy the 50 delta. That's 14 days out. And then you sell the 30 delta. That's closest to 7 days. And once the sell side reaches 0, right? This is the last day of trading for this particular contract. This is when you're looking to close both and take profit or, take a loss. Now jumping into and I will jump into both Tastyworks and Robinhood as a precaution. So this is our, the Tastyworks platform that we use today. Now the market is closed, so we cannot trade any contracts. But for example, if I jump into our Discord, let's see. If I jump into the Discord and I pull up our earnings spot, let's see what we had today. So here are the earnings call. So we have a Roku and we have a Disney. All right. So let's say we do the Roku real quick. So I'll go ahead, type my ticker. So on Tastyworks, these are the different options here. So again, we're looking for the one closest to 7 days. So we're going to go for the 8 days out right here. And now we're looking for the deltas. So this side here on Tastyworks is the call side, right? You can see here, calls. And on the right side, you have your puts. We're only dealing with calls. And we're looking for the 40 delta, which is 0.40. So in this case, 0.39 will be the closest one. You can see here, if I were to buy this contract right now, we're looking at a price of 11.35 cents. Now remember, a contract holds 100 shares. So you will multiply this number by 100. So this contract in itself would cost $1,134 or $35. And what this looks like,
you're actually looking at the 30 delta, Ed, and we're selling it here.
No, I went with the earning one on top.
Oh, okay, yeah, my bad.
On Roku. Yeah. Now the reason for this, the price of this contract being so high is just the price of Roku. It's a $400 stock, right? So the higher the price of the stock, typically the higher the price of the option. Now what this looks like from a profitability standpoint, as you can see here, you have these two lines. You have this horizontal, and then it goes, diagonal around 45. And this will be at expiration. And this theoretical, arc right here is the theory of the theoretical price of the option as time proceeds. So if we actually today's the 28th. So as we fast forward with time, you'll see that this line starts to marry here. Now, what we're trying to take advantage of is the fact that earnings is coming up, and the fact that as earnings gets closer, volatility has a tendency of increasing. So as you can see here, the option will gain in value just by volatility just increasing on its own. Additionally, it doesn't take much for the stock to move in either direction for it to, hit a 40% profit or loss. But again, the phenomenon is as earnings get closer, the stock has a tendency of moving up. So that's on the Tastyworks platform. Let me just go ahead and jump into like Robinhood. I think I was looking at this earlier. Okay, so let's take, for example, Disney here, right? Buy the 7. So on Robinhood, it's a little different, right? You have this trade Disney options. And so you're gonna have to do a little bit more math in your head, right? So we're looking at the February 12th, right? And now in Robinhood, you have to expand these tables so you can see the delta on the bottom left. So you can see each one, right? So here's the 33, here's the 40, here's 38. So I'll probably be looking at this one. That's the closest to the 40. And so you hit add, and you can see here's your contract. It's priced at $4.30. You times that by 100. So the total cost is going to be, $430 to buy one of these options. So that's on the call side. Again, if you look at this graph right here, the most you could ever lose would be what you paid for the contract, which in this case was $1,135. But again, we're only looking for a 40% loss. So, which in this case would still be around $400 and something, but at the same time, the gains would be around $400 and something. So that's on the call side. Hopefully that made sense. Anything you want to add, Joe, on the call side? Or was that good enough?
No, I think that was great. Yeah, we're just looking for that phenomenon with the volatility increase, and we want to take advantage of it. And there's also been a phenomenon in recent years where, especially in the tech industry, we're looking at stocks as they approach their earnings tend to increase in value. So we're trying to take advantage of both of those.
Exactly. All right, so let's jump into a little bit more intermediate strategy, as I would call it. And in this case, it's the earnings diagonal. And I do believe I did pull the NVIDIA here. So let's just take a look at that real quick. So I did pull the NVIDIA. So in this case, I did purchase this option contract today. And as you can see here, I sold. So, right, you see this -1. So I sold this contract to a trader. And simultaneously, I purchased the secondary contract not long after. So let's go through a new example real quick first. Let's do Disney. So I believe Disney was on the list. So we go back to our little table. We want to sell the one that's closest to 7 days. And we're looking for the 30 delta, right? So that's right here. So this is the price somebody's willing to pay you for this contract. Now, because this is a spread, we're going to add two contracts together. So now we're looking for the 14 DTE, and we're looking for the 50 delta. So we'll be buying this. So you can see here, this contract is $630, but what we'll be paying is $430. And the reason being is because we're selling a contract, and so the price is offset. And the way this looks like from the profitability standpoint is, again, we're looking for that earnings play, right? It's gonna move up and to the right. And our strategy here is to close this position after 8 days. Now I've been personally taking profit once I've hit 40%. Joe, I don't know about you, if you've been letting them ride to expiration or.
I let them ride to expiration. I just like the overall win percentage on that. I think is nice. And then, this goes back to the whole position sizing risk management thing. If you're closing at 40% take profit, you should be closing at 40% loss, just to make it equal in what you're doing. Can you show the volatility increase on this?
Sure. All right, so let's see, which one do you want to increase? So if you increase the one that's further out, the call that you buy,
right, you're going to see the expansion there. So typically what we're going to see is the expansion of volatility, typically on both options, especially on the back one, because the back one is behind the earnings date. So we don't know what's going to happen at earnings. So there's always this question. Therefore, volatility increases a little bit faster than it would on the front end. But in addition to that, if you click through those days, you'll also see the increase of the curve here. So it becomes more and more profitable as we come to that last leg of the expiration. So we're taking advantage of that phenomenon as well. It's overall great strategy. I prefer this over the call strategy because it also takes away the cost of a call, because a naked call by itself is going to cost more. without that short leg, because the short leg you gather some credit, so it helps mitigate some of the cost of the call while you're still getting the value of the call in the overall option play as well.
Yeah, no, completely agree. I mean, I'm liking the diagonal actually quite a bit. We did not have the diagonal last season. This is the first season we're having it, but so far, I mean, I know we've had members profiting from this a little bit more than the calls at the moment.
Yep. The other thing with this call is we're taking, there's a paradigm that happens during, another phenomenon that happens during options, during earnings, where the options actually accelerate on the short end. The theta actually accelerates shorter than 7 days as it approaches earnings. So like when you get 3-4 days into earnings, you're really collecting majority of that credit that you get just based off of theta decay alone. So it's just an overall, just really, really sound strategy. It takes advantage of volatility, theta decay, and also just the price increase as we get towards earnings. Ed, one more thing before you go to Robinhood. So there is one thing that all traders should pay attention to when it comes to trading these diagonals. And if you take the difference of the strikes, so in this case, we have the 177 and 50 cent strike, and then we have the 172 and 50 cent, and you subtract those, you're going to get 5. So if you go ahead and add on the price for this debit, and let's increase that to beyond $5. Let's try to get like $6 on there. Okay, so now you see instantly what just happened, right? The right side is no longer profitable at a certain point. And so whenever you take these diagonals, you just want to make sure that the credit that you, or the debit that you pay for these diagonals is less than the spread of the strikes, the less than the width of the strikes. That's just going to ensure that you're going to be green no matter how far up the price moves. Otherwise, you're kind of capped out. Because if you zoom out a little bit, Ed, on the so like once you reach past 190 there, like 187, you start to actually lose money. You're capped on the amount of money you can lose, but if you go back and if you change this back to $4, you could see that we're not going to lose any money if we get to that 190 side. So just something to pay attention of. It can decrease your win percentage. So that's the only caveat with these diagonals. You don't have to pay attention to that, but you're going to have a better win percentage if you do.
Yeah, no, that's fantastic. I usually forget that little rule of thumb, right? You subtract these two, make sure you're paying less than that difference of the strike. Now, real quick on the Robinhood, yes, you guys can see it. Let's see here. So let's go ahead and what was the other ticker that was in here? I guess we can do NVIDIA again. So again, now to execute this on Robinhood, same principle, right? You're looking for that 7 days. Now remember, we sell the front half, right? And we're looking for the 30 delta. Let's see here. A bit too far. There we go. 30 delta. So we're going to add this. And then we're going to buy the week after. We're looking for the 50 delta, which is usually right at the share price. That's easy to find. If I add these two together, you see this change to custom, and you can see, here's the difference. Now, if you subtract this, right, to Joe's point, this would be 25. So we're definitely paying significantly less. So no risk to the upside. That's pretty much it. The only other caveat, you can't do this in Robinhood, but you can in Tastyworks. So like for positions that I typically have open, such as this is a earning spot play right here, I'll typically just set up a bracket. So I'll automatically just close out for 40% win or 40% loss. I don't believe you can do that in Robinhood. You can set an order to close, beforehand, but I think you can only do it on one side. So you can set it to close on the profitable side, but if the stock moves against you, then you might miss out. So I usually like these platforms a little bit better. So just throwing that out there. So going back to the PowerPoint real quick. So that's pretty much it for us. Now, again, Earnings Bot is free this earnings season, so make sure you take advantage of that, right? The play's on Discord, the play's on Twitter, so feel free to follow either or. The other portions that we offer in the Discord channel itself, we have another algo called Lambda Trader. There's YouTube videos on those, and we're planning to do a session on that in the near future. But again, very similar principles. That one actually recommends up to, I think, 12 different option strategies, but similar principles for a high, I believe the back ratio was like 60 to 70% profitability if you follow the Lambda Trader trades.
Yeah, our back test came out to around 70% on all the trades, cumulative. It also defines entries and exits for you. And again, that comes free with the membership. We love Lambda Trader. We built a bot around it too. So you don't even have to, look for plays. It'll just call them out, and then you can go on TradingView and pick them out. And then usually there's like multiple plays on there, so you could pick which play you prefer. There you go. So this guy is just calling them out for you. It calls the spot price where it saw that it triggered on Lambda Trader. So in this case, Zoom triggered at 377. And you just pop up Zoom and you can look at the trades. There should be multiple Lambda Trader trades there.
Kind of flat.
Oh, how is what is our year to date since inception performance for our alerts?
Year to date for inceptions. Well, it's definitely gonna be a lot better tomorrow, I'll tell you that. Where's it at? I think we're sitting at around 500. Just on the alert side.
Go back to inception totals here, down low.
Oh, inception totals.
Yep. So since we started, we're at almost $1,100 or $11,000 in total alerts, and these are all. We don't delete anything. We try to track everything as best as possible, and everything is actually in our alerts channel, so you can go back and see them and trace them back if you want. They're all there.
Yeah, I mean, again, this is definitely gonna pop over 2,000 tomorrow. So I am excited for Friday. I'll tell you that. So, but yeah, other than that, that's it for us. If there's any questions, let us know in the chat. Or other than that, thanks for participating. And we'll make this video hopefully available most likely through YouTube. For future reference. But other than that, you guys have a good day.